Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today's Thursday, February 28th, and we're talking XPO Logistics. I'm your host, Nick Sciple, and today I'm joined in studio by MFAM Fund's Bill Barker. How's it going, Bill?
It's going well. Thanks for having me.
I'm glad to have you as well. And, this week we're answering a listener question from our listener, Peter F. Smith. So he listened to way too many Motley Fool podcasts, has investing since he was a teenager. But he wants us to talk about XPO Logistics. He says it's a pick in one or more of the Motley Fool funds and ETFs. He just read their transcript from the last conference call and couldn't square what was said by management with the recent movement in the stock. Well, Bill Barker is from MFAM Funds and has been following XPO Logistics for a little while. Bill, before we dive into this company a little bit, when I was talking to you last week as we were getting ready to record this episode, you had a very interesting story about how you came across this company. And it's just kind of indicative of how you always got to have your nose out for opportunities. So can you talk to us a little bit about how you first encountered XPO Logistics?
Sure. I was at so I spend most of my time on the funds that we have and MFAM funds. So back in 2012, I went to a conference in New York hosted by Credit Suisse, I believe, and their normal conference mechanics are there are a bunch of tracks where you go into one room or another to listen to management presentation, and I had a certain presentation that I wanted to hear in one of the four rooms during the, let's call it the 2:30 to 3 o'clock block, and then the 3 o'clock block I didn't have anything that I was particularly interested in seeing, so I just stayed in my seat for the next presentation, which was XPO Logistics, and it was just a series of letters and a word logistics. I thought this couldn't possibly be interesting, but easier to just stay in my seat than go walk into a different room. And it turned out that they were giving a presentation, this is in 2012, on their plans for growth and Bradley Jacobs' history in executing roll-ups in other industries and the attractiveness of doing it at the time, strictly in truck brokerage, and the growth numbers through a roll-up strategy that they were projecting seemed hard to believe. And I'll just say that what they've done since then is far bigger a growth roll-up strategy than they were presenting even back then.
Sure, Bill. And for our listeners who may not be familiar with what a roll-up strategy is and what it entails, can you just explain that in just a very general terms for maybe someone who's new to that term?
Sure. It's the acquisition of other businesses, either what we might call a tuck-in business, which is a small piece to add to a large piece of what you've already got, or a major acquisition, which is sort of transformative to the business. And at the time, just to put some numbers around that, I think the company was doing, let's call it $150 million a year in revenue, and the plan was to grow to something billion over a period of time. Of course, they're a $17 billion revenue company today. That's growth of 100x roughly, and that is only achievable in most businesses through acquiring other businesses rather than through purely organic growth, which is, for the most part, organic growth is more attractive, growing your own business rather than paying up to acquire other businesses. And I'll just say that for the most part, I wouldn't recommend pursuing companies that have a roll-up strategy because it tends to lead to empire building, and while it can be rewarding to shareholders, more often it's not. Right, and
XPO Logistics, as you mentioned, has been very aggressive with that strategy. The number I saw is between 2012, when you first kind of discovered the business, 2015, they acquired 17 U.S. and European businesses over that time. Can you talk about the industry in which they operate? Obviously, with XPO Logistics, it's a trucking and logistics company. You mentioned the logistics brokerage services. Can you talk about the kind of businesses that XPO has been acquiring and their strategy in doing so over time?
So back then, 2012, truck brokerage, what is that? That's basically being a middleman between the trucker and the company that needs goods moved. And so if they don't have their own fleet, which most companies do not have their own fleet. Of course, if you're driving around, you'll see a Pepsi sign, PepsiCo on a truck, or any number of other major names which have the capacity to move their own goods. But most companies are using somebody else to move their goods. And so trucking companies, there are several large players, but more often, it's a mom and pop kind of operation where you've got literally, the pop is usually the truck driver, and the mom is handling the side of the business on arranging some of the work. And you've got to keep your trucks full. You got to be out on the road. You build up a little fleet, and maybe 5, 10 trucks, something like that. That can be a good business, but you've still got to have customers. And XPO is on the truck brokerage side, putting truckers together with merchants.
Right, and I believe at least they mentioned in their filings, the second largest freight brokerage provider worldwide based on the value of freight under management. So they've really grown significantly over time with these acquisitions. One of the areas in which XPO specializes, and I wanted to call out, is this idea of less than truckload transportation. Can you just discuss for our listeners what the significance is of less than truckload transportation, how XPO is positioning themselves in offering those services, and what potential that has for some growth for the business over time?
Sure. The less than truckload is so. All right, let's use some round numbers. There's about call it $1 trillion of transport going on in the U.S. annually, and about 700 billion of that is trucking. And the other, you've got air cargo, you've got shipping, you've got a few other ways to move things rail. But trucking's about 700 billion. Of that 700 billion, about 600 billion is going to be full truckload, and about 40 billion annually is going to be less than truckload. And less than truckload is just the mechanics. It's a truck that's picking up a bunch of different cargoes along the way, and then bringing them to distribution center, and maybe that cargo gets put on another truck. So it's a logistics intensive industry, unlike truckload, which for the most part is the truckload is a full truckload of one thing that's going in one place, and so that is the larger part of how things are moved. But still, $40 billion annually is a good business to be in, and it's a little bit more insulated from protection in terms of the logistics are just more complicated in moving something with a number of different customers to a number of different places. A couple of years ago, XPO did something that it had said it wasn't going to do, which was to get into this asset-intensive trucking business. And it bought Conway, and this was an operation which had substantial revenues and substantial EBITDA, but was not an especially well-run operation. And then they acquired a European operation called Norbert Dentressangle, and between those, they wound up with a lot of both less than trucking and trucking. What they did is they sold off the trucking, held on to the less than truckload of Conway, and so that offers them the opportunity to serve their customers with a lot of different operations. So the other things they do, intermodal, is when a ship comes in and then you put it on rail. Drayage is sort of moving things around within ship off the shipping, and they've got the less than truckload operation, and the truck brokerage. So they've got a lot of different ways that they can serve their customers.
Right. And I think what is particularly interesting to me and maybe attractive to look at this space right now is as e-commerce has emerged over time, the complexity of of logistics and moving things around has only increased as we, move small numbers of packages to individual homes versus large numbers of what might be full truckload shipments to maybe stores or things like that. So as the role of e-commerce grows in the economy, what opportunities does that provide for XPO Logistics? Is that the main driver for their business over time? Or how should we think about the shifting demand for logistics and what role that might play in XPO's business moving forward?
Yeah, it's still rapidly growing. And the last mile challenge, and they're the leader in last mile deliveries. And so that's getting that package, not really package. They're moving heavy goods on the last mile. So if you order a washer or dryer, it needs to be installed in your house, there's a very good chance that XPO is going to be the one doing that. And that is high touch. You've got skilled labor that's involved, and it's very consequential to the purchaser whether it's done right and whether the right window is met and all that. And so there are better profits to be gained by doing that right than by just moving parcels around. As good as the parcel business is for UPS and FedEx and the U.S. Postal Service, that is a business that XPO is not going to get into. But the last mile heavy goods stuff is growing because of the growing use of e-commerce, and it has been growing very nicely for XPO, although, as we'll get to, there's been a little hiccup in that.
Yeah, and let's talk about that hiccup. A little bit of XPO's recent performance has maybe disappointed investors. If you look at the share price, it's down over 50% since its highs back in October. In the most recent earnings call, CEO Bradley Jacobs, right off the top of the call, said, quote, "There's no other way to say it. We just missed the quarter." What happened in XPO's recent results that generated this sharp decline in share price, and how should investors think about that?
So XPO going into October was trading over $100 a share. And one of the reasons for that is that the company had not only put forward aggressive guidance over the past 5 or 6 years on its growth, and it's hitting certain metrics, the company adjusted EBITDA numbers and things like that. I won't get too much into the accounting details, but having hit them consistently for 5 or 6 years. Then the third quarter earnings came out, and they missed their numbers because of a bankruptcy in Europe. And not only missed the number for the quarter, it was really one customer prevented them from hitting the previous guidance, but they lowered their guidance for the fourth quarter. And so that was a new part of the story, which hit the stock fairly hard back then. And then there was a short seller report that came out in December, but still, mostly the stock had delivered on the stories that it had, the guidance that it had provided. Then the fourth quarter numbers came in, a couple of things happened. One, there was weakness in England, the UK, and France, as Europe has slowed down and as Brexit worries have impacted there. So that was part of it. And a bigger part was that XPO's largest customer in the fourth quarter pulled their postal injection business, and then a couple weeks later pulled another big chunk of their business. And so XPO had to radically reduce their guidance for 2019.
Right. And following up on that largest customer, you mentioned it was the postal injection business. Just for our listeners, postal injection is when a large shipper will have a large number of packages that maybe they have at a distribution center. And postal injection is taking those unsorted packages from the distribution center and then taking them to the USPS and then injecting those into the USPS's logistics system. USPS recently increased its postal rates, which may have played a role in this. But there is some speculation about the identity of this customer. Management said on the call this had been a $900 million customer, but has now reduced its its spending to now become around a $300 million customer. When you talk about losing $600 million in revenue going forward, you think it is probably a very, very large business that XPO is doing business with. And there's been some rumors that this company is Amazon. What thoughts do you have on this kind of rumor on that, who the identity of this customer might be? And if it is Amazon, what are your thoughts on the idea of XPO losing this business moving forward?
Yeah, I think the speculation that this is Amazon is pretty much on par with sort of the speculation that in previous filings, individual one might be Donald Trump, right, for instance. It's not stated, but really there is no other possibility that can be. And so Amazon has pulled approximately $600 million of their $900 million of annual business. And presumably the reason they have not pulled the other 300 is that, not presumably, they have long-term contracts. So where they didn't have long-term contracts, they're out. And assuming, given the 99% probability that this is Amazon, why'd they do that? Well, they have been staffing up for bringing logistics business in-house. And so this was not a shock. This was not a shock that this was going to happen or would very likely happen someday. The timing was a shock to the company. The postal injection business was pulled right before Christmas. And then this other deduction in business was done right before the company announced its earnings. And why might Amazon have done this? The speculation includes, and let's underline that this is speculation, a fairly high-profile hire for XPO. Their new COO had been at Amazon and was pretty useful guy at Amazon. Maybe this is retribution for that, and I can't say anything other than that's speculation. And if that's the case, then you don't look at this as having failed to serve a big and important customer in the right way, as much as having risked put the business at some risk that Amazon might do this by hiring away somebody, and having now seen that risk come up into reality. So I don't know that I would excuse Amazon or XPO, for the consequences of the action if it was predictable.
Right, and it's worth saying this is concerning news. Amazon was a large customer for XPO, but XPO does have a large number of other customers. Amazon or this individual customer, whoever it was, I believe management said it was around 5% of total revenue. So a large chunk, but not a double-digit amount of revenue that would be impacted over time. And management has still remained bullish on the business's prospects moving forward. They just completed a $1 billion share repurchase that they put forward following the short seller report you mentioned a couple months ago. And at the beginning of February, they just approved another $1.5 billion in repurchases. So as you see, Bill, management continuing to double down on repurchases of the business in the face of what appears to be some troubles. How do you think about that as an investor or someone watching the company?
So I have two thoughts. One, a lot of the optimism in the company was when it was going for over $100 a share back in October. Not only were there good current numbers that the company had delivered on, but there was just, looking in the rearview mirror, this is a company that had grown at the pace that it had grown and was talking about making additional major acquisitions. In fact, they had conducted a secondary within the last 12, 18 months, I can't remember when it was, to have some money available for an additional acquisition. And they were talking about making acquisition up into the $6 billion mark. Well, that was a story that had attracted Wall Street's analysts and investors consistently pretty much over the last 7 years. And now the company has really reeled that back in and said, we're not going to be making any major acquisition. They had taken a pause on acquisitions as they looked for the right thing at the right price. And now they are just buying back their shares with as much money as they can get their hands on, and they're taking out some debt to do that. They already had debt. They've been paying debt off for the last 2 years. You don't grow 100x without issuing shares or taking on debt, and they've done both, and they've had a bunch of secondaries. They've taken on a lot of debt. Now they're buying back shares. So there's a financial engineering. And if that sounds negative, I don't mean it to sound negative. They have taken advantage of a high stock price in the past by having secondaries. They've taken advantage of cheap debt by issuing a lot of debt. Now they are, under their declaration, taking advantage of a low stock price, and they have a pretty good track record for doing the right thing with shareholder capital. But this is not a strategy that does not come with some risk.
Sure. Yeah. Definitely encouraging that management is still seeing value in their shares after the steep decline. However, this shift in strategy, over what the business has been, for the past 5 or so years, is something that we'll have to see how things develop.
Yeah, I think before. All right. So we've owned this company in a couple of our funds for 7 years, and we saw it go. We were getting it back in the sort of $16 a share was back when we were buying it in 2012, and we've seen it be cut in half once before, and that was in reaction to the acquisitions of Conway and Norbert Dentressangle, which made the company. Previously, it was a very, very asset-light company, and that is very attractive because they can take advantage of a good economy, hire more people, get on the phones, use technology to put the shippers and the truckers together. But taking on the trucks, in which they've done with these 2 major acquisitions, made them a mixed business, but far more asset heavy and far more cyclically exposed. And so the change in strategy led to the stock being cut in half. It rebounded from that, tripled again, back to where it was in October. Now it's been cut in half again because, in part, 1, they've failed to deliver on guidance. 2, they've lost this major customer. And 3, they've changed strategy from we're going to be a M&A king to we're going to buy back our own shares. And you've had a lot of, I would say, Wall Street enthusiasm around the story and the execution of the stock. In part, one cynically could say because they're a very good customer of Wall Street. They have had all these secondaries. They've had all these debt issuances. Getting involved in M&A deals is good business for Wall Street, and they've been a good customer. And so part of the short seller report that we talked about mentioned that or accused Wall Street of just being in the bag for XPO and pumping up the stock price. Well, I think that XPO has delivered a pretty impressive story, but it is also true that there are plenty of Wall Street firms that want to do business with XPO.
Right. Definitely going to be an interesting story to see as, the strategy develops over time. And given that they've, navigated through such a strategy shift in the past and been able to maintain momentum, definitely encouraging for a shareholder. Obviously these things can create some volatility in the near term, but as we look out as true long-term shareholders at the trajectory of XPO moving forward, is the thesis still intact on what the value proposition that XPO brings to an investor? And are you concerned about this kind of short-term volatility?
Well, it depends on what your thesis is. If your thesis is, I believe that management, in this case, Bradley Jacobs, the CEO, is a good allocator of capital and can see opportunities in terms of acquisitions and then actually do the hard work of integrating these acquisitions in a way that most cannot. I think that's intact because he's still there. Some of the other management have left in the last 18 months. And so if your thesis went beyond Bradley Jacobs, then you've got to identify whether the CFO, they're looking for a new CFO. They've brought in a new COO. The chief strategy officer has also changed in the last 9 months. So I think that you have to determine what is your thesis. If your thesis is this is going to be a rapidly growing company, the thesis has changed. Right now, it is still growing, but it's not growing at anywhere near the pace that it was. And so you've got probably in the market a bunch of growth investors getting out of the story and value investors looking at it right now. And it's certainly not deep value, but it's trading below at multiples below the comp group. So I think that it has a mixed, you have to compare it both against trucking companies and against truck brokerage companies. So you have to do the work there. But I think at today's prices, it's going to find some value investors.
Yeah, definitely will be an interesting story to follow as the narratives around the company change. And as you mentioned, maybe the shareholder base of the company changes. Operating in this logistics industry, which as we mentioned earlier, with the emergence of e-commerce, really is going to be a key cog in that trend going forward. Definitely interesting company to watch in that space. Bill, thanks so much for coming on the show to talk about XPO a little bit, and hope to have you on again soon.
Oh, thanks for having me.
Awesome. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Bill Barker, I'm Nick Sciple. Thanks for listening, and Fool on.